The stock market is currently witnessing a violent repricing event in the medical technology sector that demands immediate attention. And if you are looking at the tape right now, you are seeing Heartbeam Inc., ticker symbol BEAT, trading at exactly $1.29 USD, up a staggering 0.48 cents or 60.17% on the session. This is not a drill. And this is not your typical midweek drift. This is a high-volume breakout driven by a fundamental catalyst that changes the entire thesis for this microcap company. When a stock under $1 suddenly rips 60% in a single trading session, the immediate assumption from the retail crowd, those trading on the Robinhood app or casually checking their SoFi Invest dashboards, is that this is a pump, a fleeting moment of hype destined to collapse by the closing bell. The expectation is volatility without substance. However, the reality of what is happening with Heartbeam today suggests something far more structural is at play, creating a massive divergence between what the casual observer sees and what the institutional order flow is actually signaling. The volume we are seeing today is anomalous, chewing through ask walls that have suppressed this equity for the better part of 2025, and it forces us to look past the surface-level percentage gain and understand the mechanics of this move. Most investors, perhaps those comfortable with the steady compounding of Schwab Intelligent Portfolios or the passive safety of Fidelity mutual funds, might look at a chart like this and see danger. But for the active trader, this is where the market inefficiencies lie. The catalyst driving this move is the FDA 510(k) clearance for Heartbeam's 12-lead ECG synthesis software, a regulatory milestone that the market had largely written off after previous setbacks. This morning's announcement that they successfully appealed a prior, not substantially equivalent determination has caught a massive amount of short interest offside, triggering a squeeze that is compounding the buying pressure from fundamental value investors who have been waiting for this precise validation. We need to strip away the noise and look at the technology, because that is where the tension between expectation and reality is sharpest. The general public expects cardiac monitoring to be solved by big tech. You wear an Apple Watch, you get a notification, you think you are covered. That is the expectation. Consumer wearables are good enough. The reality is that single-lead ECGs, like those found in the Apple Watch or standard Fitbit devices, are incredibly limited. They can detect atrial fibrillation, sure, but they cannot effectively detect a heart attack or complex arrhythmias because they lack the spatial view of the heart's electrical activity. Heartbeam is not trying to be a better Apple Watch. They are bringing a hospital-grade 12-lead ECG experience into a credit card-sized device using 3D vector technology. This is a profound difference. While the market has been obsessed with NVIDIA stock and the AI semiconductor narrative, or wondering if Tesla stock can break new highs, a tiny player like Heartbeam has been quietly building an intellectual property moat around vector electrocardiography that allows them to synthesize 12-lead data from just a few points of contact. This clearance validates that the FDA agrees the science works, and that one piece of paper from the regulator instantly transforms the company from a science project into a commercial entity. However, let's pause and look at the trading dynamics on platforms like Interactive Brokers or the thinkorswim terminal. You are seeing a massive rotation of capital. The float on BEAT is relatively small, which means when news of this magnitude hits, the liquidity vacuum drives the price vertical. We are seeing bid stacking at the $1.20 level, suggesting that buyers are stepping up to defend the new range. This is not just day traders flipping pennies. This volume signature indicates that smaller funds and perhaps some speculative family offices are starting to accumulate a position now that the regulatory risk is off the table. It is similar to what we see when a biotech firm gets drug approval. The risk profile flips overnight. Yesterday, investing in Heartbeam was a gamble on a binary regulatory event. Today, it's an execution story. But here is where I need to offer a contrarian check to the euphoria. While the stock is up 60%, we must talk about the balance sheet. Developing hardware and software is capital intensive. If you are using Fidelity Investments or have a managed account with Fidelity Wealth Management, you know that risk management is priority number one. Heartbeam has been burning cash to get to this point. The reality that investors need to accept is that a stock price surge often invites a capital raise. It is very common for companies in this specific position to utilize the increased liquidity and higher share price to issue new equity, effectively diluting current shareholders to fund their commercial rollout. The expectation is that the stock goes to the moon. The reality is that the company needs to pay for the rocket fuel. This doesn't mean the move is over, but it means you must be vigilant. If they announce an offering in the coming days, we could see a temporary pullback, which sophisticated traders on Interactive Brokers trading platforms will likely treat as a buying opportunity rather than a panic signal. Let's widen the lens and discuss where this fits in the broader investing landscape. We live in a time where retail access to markets is unprecedented. Whether you are using the Robinhood app for fractional shares or executing complex option strategies on SoFi Active Investing, the speed at which information travels is instant. In previous decades, this FDA news might have taken days to fully price in. Today, it happens in milliseconds. This efficiency is why you see such violent gaps, but for the individual investor, the self-investing crowd, the danger is FOMO, fear of missing out. You see the plus 60% green number and you want to hit buy. But you have to ask yourself, are you buying the news or are you buying the future cash flows? The clearance is the starting gun, not the finish line. The company now has to manufacture, market, and sell the device. They have to get insurance reimbursement codes sorted. They have to convince cardiologists to trust a remote device over their in-office machines. This is the commercialization valley of death that many medtech firms face. I want you to take a second and comment below how many shares of Heartbeam you currently hold, or if you are watching from the sidelines. Are you chasing this momentum, or are you waiting for a pullback to the $1 level? Now, let's analyze the technicals of this move compared to other high-beta names. When you look at high-flying tech stocks, say comparing the volatility here to crypto assets on Robinhood Crypto or small-cap tech ETFs, Heartbeam's move today is statistically significant because it broke a multi-month downtrend. The stock had been languishing below the $1 mark, putting it in danger of delisting notices and general irrelevance. This move to $1.29 repairs a significant amount of technical damage. It puts the price back above the 200-day moving average, a key indicator that algorithmic traders and robo-advisors watch closely. Even a Schwab Intelligent Portfolio algorithm, which is designed to be risk-averse, takes note when a stock reclaims its long-term trend lines, although it wouldn't buy it directly. The psychological impact of crossing the $1 threshold cannot be overstated. Institutional mandates often prevent funds from buying stocks under $1. By breaking and holding this level, Heartbeam effectively unlocks a new tier of potential institutional capital that was previously barred from entering the trade. It is similar to what we see when a biotech firm gets drug approval. The risk profile flips overnight. Yesterday, investing in Heartbeam was a gamble on a binary regulatory event. Today, it's an execution story. But let's discuss the product itself in more detail, because this is what justifies the long-term hold thesis. The Heartbeam iMigo device is the core of this discussion. It is the first cable-free, credit card-sized system intended for patient use at home. When a patient feels chest pain, they don't have time to drive to the ER or book an appointment. They need to know right now if it's indigestion or a heart attack. Current wearables cannot tell you that reliable answer. Heartbeam's technology captures the signals in 3 dimensions, X, Y, and Z axes, and uses a transformation matrix to spit out a 12-lead equivalent. This is the same data a doctor gets from sticking 10 electrodes all over your chest in a hospital. If they can capture even a fraction of the market for at-risk cardiac patients, millions of people with history of attacks or arrhythmias, the revenue potential dwarfs the current market cap. The expectation was that this tech was too complex for a handheld device. The reality, validated by the FDA today, is that it works. We should also consider the competitive landscape. You have massive giants like Apple and privately held players like AliveCore. Apple has immense cash reserves in distribution, but they are focused on general wellness and mass market appeal. They are unlikely to build a dedicated 12-lead device because it creates regulatory headaches and form factor issues for a watch. This leaves a massive opening for a specialized player like Heartbeam to become the standard of care for high-risk remote monitoring. In a way, they are the specialized surgeon to Apple's general practitioner. This differentiation is vital. If you are analyzing this stock on your Fidelity trading platform or looking at research notes on Interactive Brokers, you will see that analysts often apply a takeout premium to companies like this. The logic is that once the tech is de-risked, which happened today, a larger player like Medtronic, Boston Scientific, or even Apple might just write a check to acquire the IP rather than compete with it. But we must return to the macro environment.